China holds a large amount of United States government-related debt. Some estimates focus on roughly $760 billion in U.S. Treasury securities, while broader tallies add holdings of agency debt linked to housing finance institutions such as Fannie Mae and Freddie Mac. When you combine those categories, the total often cited is about $850 billion. This matters because big holders can influence market conditions, not by pressing a magic button, but by changing the balance between supply and demand. Here is the core idea. The United States runs persistent budget deficits, which means it issues new bonds regularly to fund government operations. In a healthy market, those bonds are absorbed by a wide set of buyers, including domestic investors, pension funds, banks, and foreign reserve managers. For many years, China was one of the major foreign participants in that system. If a large buyer slows its purchases or begins to reduce its holdings, the market has to find replacement demand somewhere else. If selling increases while new issuance continues, the amount of bonds available to the market rises. Basic bond math then takes over. When there is more supply than demand, prices tend to fall. And in bond markets, falling prices are linked to rising yields. That yield is effectively the interest rate investors demand to lend money for a given period of time. This does not guarantee a sudden collapse, and it does not mean any single country controls the entire market. The U.S. Treasury market is deep and global, and many factors move yields, including inflation expectations, economic growth, and central bank policy. But the direction of the pressure is clear. Reduced foreign demand can force the market to reprice debt at higher yields, especially when issuance is heavy. And higher yields in the bond market can ripple outward, raising borrowing costs across the economy over time. As those higher yields begin to appear in the bond market, the next key point is how control is divided between the Federal Reserve and the market itself. The Fed has strong influence over very short-term interest rates through its policy tools. It can adjust its benchmark rate and manage liquidity in the banking system. However, longer-term rates, such as those on 10-year government bonds, are shaped much more by investor expectations about inflation, growth, fiscal policy, and risk. This distinction becomes important when bond supply is heavy and major buyers step back. If investors believe they are taking on more risk, they will demand higher yields to hold long-term debt. That decision happens in millions of trades across global markets, not in a single meeting room. Even if the Fed signals easier policy or lowers its short-term rate, it cannot directly order long-term investors to accept lower returns. Mortgage rates are closely linked to these longer-term yields, especially the 10-year Treasury. Lenders use those yields as a reference point when pricing 30-year home loans. So if bond selling pushes the 10-year yield higher, mortgage rates tend to rise as well. This can happen even during periods when the Fed is trying to support the economy, creating a gap between central bank intentions and market outcomes. It is more accurate to call this a shift in influence rather than a total loss of control. The Fed still matters, but it is one player among many in the long end of the market. When fiscal borrowing is large and investor demand changes, market forces can dominate. The result is a financial environment where long-term borrowing costs reflect global supply and demand for capital, not just domestic monetary policy decisions. When these higher long-term yields feed through the system, the pressure does not stop with households and mortgages. It also lands directly on banks and the broader financial system. Many banks built their portfolios during years of very low interest rates. They purchased government bonds and other high-quality securities that were considered safe and stable at the time. The goal was steady income with limited credit risk. The challenge appears when interest rates rise quickly. Bond prices move in the opposite direction of yields. So as market yields climb, the market value of older bonds with lower coupons falls. On paper, this creates unrealized losses on bank balance sheets. These losses do not always hit earnings right away, because accounting rules can allow banks to hold certain securities without marking them fully to market, as long as they do not sell. The situation becomes more serious if depositors pull money out. When customers withdraw funds, banks need cash. To raise that cash, they may have to sell securities. If those securities are worth less than their purchase price, the unrealized losses become realized. That directly reduces bank capital, which is the buffer that protects against further shocks. Support facilities from central banks can help during periods of stress, but these tools are not permanent substitutes for strong balance sheets. If higher rates persist for a long time, the strain can build. Banks face tighter margins, more cautious lending, and greater sensitivity to market swings. This means that rising yields are not only a story about borrowing costs for consumers and businesses, they are also a story about financial stability, confidence, and how resilient the banking system is in a changing rate environment. As stress builds inside the financial system, the effects begin to spread outward into the real economy. Higher long-term yields translate directly into higher mortgage rates. When home loan costs rise, monthly payments increase for new buyers, and affordability declines. Fewer households can qualify for the same size loan, which can cool demand in the housing market. Slower sales and tighter budgets can place downward pressure on property prices, especially in areas where valuations had been supported by very low rates. Housing is not just about shelter. For many families, it is a major part of net worth. When home values stop rising or begin to fall, the so-called wealth effect can weaken. People may feel less comfortable making large purchases, taking vacations, or upgrading durable goods. Since consumer spending represents a large share of overall economic activity, this shift in behavior can slow growth. Businesses face a similar adjustment. Companies that borrowed during periods of cheap credit eventually need to refinance. If prevailing interest rates are much higher, their financing costs increase. That can squeeze profit margins and lead firms to delay expansion, reduce hiring, or cut expenses. In more fragile cases, higher debt service can contribute to restructuring or bankruptcy. Slower growth has fiscal consequences as well. When economic activity cools, tax revenues can decline while social spending pressures rise. Governments may then rely even more on borrowing to cover gaps. This can add to the supply of bonds entering the market, reinforcing the link between deficits, interest rates, and growth. It is not an automatic downward spiral, but it does illustrate how closely connected credit conditions, asset prices, business health, and public finances can become during periods of sustained high rates. As these domestic pressures build, the discussion often expands to the international role of the United States dollar. For decades, the dollar has played a central role in global trade, finance, and reserves. A large share of commodities, including oil, has traditionally been priced and settled in dollars. This practice encouraged countries and companies to hold dollar balances and invest in dollar-denominated assets, including U.S. government bonds. However, the global system is not static. Some countries have explored settling portions of trade in other currencies through bilateral agreements or regional arrangements. These shifts are gradual and uneven, but they can slightly change the pattern of demand for different currencies. If a smaller share of global transactions requires dollars, the incentive to hold large dollar reserves could evolve over time. At the same time, central banks manage their reserves with diversification in mind. In recent years, several have increased their gold holdings as part of a broader strategy to balance currency risk, liquidity, and safety. Gold does not depend on the credit of any single government, which gives it a distinct role in reserve portfolios. This does not replace major currencies, but it can alter the mix. The combined effect of these trends may influence how easily the United States finances large deficits. Strong global demand for dollar assets has historically helped keep borrowing costs relatively low. If that demand grows more slowly or becomes more sensitive to policy and geopolitical factors, markets may require higher yields to absorb new debt. The dollar remains a dominant currency, but its position is shaped by economic fundamentals, trade patterns, and international relationships that continue to evolve. When you connect all these pieces, from bond supply and long-term yields to banking stress, housing, growth, and the evolving global role of the dollar, the big theme is uncertainty. Periods of higher rates and shifting capital flows can challenge traditional assumptions about how assets behave. Portfolios that once relied on a simple balance between stocks and bonds may not respond the same way when both sides face pressure from inflation, fiscal deficits, or changing global demand. That is why many analysts talk about resilience rather than prediction. No one can forecast every market move, but individuals can think carefully about diversification, liquidity, and time horizon. Real assets, such as commodities, infrastructure, or property tied to productive use, are often discussed as partial hedges against inflation because their value is linked to physical goods and services people need. Precious metals are also viewed by some investors as a store of value over long periods, though prices can still be volatile in the short term. At the same time, it is important not to treat any single asset as a guaranteed shield. Cash provides flexibility and stability in many scenarios, even if inflation reduces purchasing power over time. Bonds still play roles in income and risk management, especially at different maturities. Equities represent ownership in businesses that can adapt and grow. The key lesson is balance, not extremes. For viewers, the practical takeaway is to understand how macro forces can affect personal finances. Review debt levels, emergency savings, and investment mix. Avoid decisions driven by fear alone and seek information from multiple credible sources. Markets go through cycles, and preparation, patience, and diversification are often more effective than dramatic, all-in moves based on any single narrative.